You were, and many people forget this sometimes now that you're at Eldridge, you were behind the strategy and a lot of the deals that made Guggenheim into a more than $200 billion asset management giant. And then you formed Eldridge. You pushed it into media, entertainment, finance, sports, real estate. In your mind, what are the themes for the next 10 years that will form the future of asset management?
Well, if I knew that, I wouldn't share it. Well, thank you very much for having me, first off. I think, obviously one of the things that is driving is scale. Value in scale, value in brands. And I think that's not limited to asset management. I think that's more broadly defined. But I think scale is continuing to become more and more important. And obviously, as you scale, then the question is there's a tension between scale and rates of return, right? Because, of course, as you get bigger, it gets a lot harder to generate rates of return. So I think you have to find places that you can go where you have the opportunity to make rates of return that are better than average, and at the same time get the benefit of scale. Whether it's compliance or marketing or anything that you're doing, there's a lot of value in scale. And you see now, in 2007, if you go back and look, right, the 5 largest alternative asset managers were all roughly the same size. It was Carlyle, it was TPG, it was Apollo, it was KKR, it was Blackstone. And they were all roughly 40 billion of assets under management. And now you look what they've done, they've all grown significantly. Blackstone's worth 150 billion, KKR's worth 100, Apollo's 70. So these things have really grown through the benefit of scale. And I think there's been a couple things that, the ones that have really grown have done really well. I think they've accessed retail money. So they have partnerships with, the big wirehouses, and everyone now is on a hunt to get to the independent RIAs. Because if you think about where the pools of capital, where alternatives aren't, the RIA is a giant market. So, I think as we're thinking about what we're doing, one of the things that we have is a really scarce asset in the form of an insurance company that issues retail policies. And we believe we're just entering kind of age peak 65. Over the next 4 years, there'll be more people that turn 65 in America than any time in the history of our country. So what do people want when they start thinking about, the future when they're 65? In our opinion, they want income. And income strategies are really what we want to be set up in order to deliver.
Is this one of the reasons you think that insurance has become such an important part of the private asset industry, the retailization of the industry?
Absolutely, but I think then you also have to look at the size and scale of the industry, right? I've just quoted the size of the top 3 largest asset managers. 25 years ago, roughly, Berkshire Hathaway was worth 40 billion, 45 billion. Now it's worth close to 900. So when you think about the size and scope of the opportunities, the insurance industry is just massive. And so, I think that the opportunity to continue to grow insurance, and I think insurance globally is becoming more and more in vogue, right? Saudi Arabia just transitioned their regulators so that the insurance industry has its own regulator, because there's really no insurance industry in Saudi right now. So what they want to do is decouple it from inside of the general financial services regulations and build their own dedicated regulator so they can then build the asset class, right? Because, of course, if you look at the big project that Saudi's trying to do, these are long-dated infrastructure projects which line up beautifully with long-dated insurance liabilities.
So we reported recently that you're creating a new money management firm that has really big ambitions, and this was according to Bloomberg sources. You actually didn't comment for the story at the time. Is there anything you can tell us about the ambition here?
Well, as I mentioned, having an insurance company, we're pretty the only top 10 fixed annuity underwriter that is quote unquote independent. So when you go looking through the list of who's the top players in those forms of insurance, they're all either attached to an alternative asset manager already, or they're all mutuals. And mutuals really are not going to be subject to M&A. So we're really the only one that's independent that is in the top 10 of both FIA and fixed annuity. And these are really easy liabilities to understand. So I think that our opportunity to continue to build our business around that with the idea that we're going to be the largest investor in every fund we launch. So we're going to be alongside as we grow and scale, and we want to do it in just credit, right? All things credit. We've got a great track record in real estate credit, structured credit, private credit, great history in equipment finance. So all of these areas, we've got good track records and a lot of experience, and I think that they're just going to continue to grow, as the market continues to grow, right? There's a lot of discussion around private credit. Broadly syndicated loans are private credit, right? So, the definition of private credit, I think, is an interesting thing. But I don't think that the boom in private credit all of a sudden suggests that private credit is bad asset class, right? We're seeing a general debanking going on, and the credit sources are transitioning, into, frankly, less levered holders, right? So if you look at the BDCs, right, the BDCs are a lot less levered than banks. So I think it's a lot safer for systems that are moving credit into lower levered institutions than traditionally where they were formed. But we think there's a big opportunity in credit. And what we want to do is just be all things credit, in partnership with our insurance company.
I want to talk more about credit for a moment, but really recently in the market, it was very widely reported that you were looking at buying a fairly sizable private credit firm out of Europe. That firm, we've reported, has gone off to seek potentially a management buyout instead. What does this say about your ambition to consolidate the asset management industry? Are you looking at more private credit firms? How large would you make of an acquisition?
Well, I think if you look out there again, there's a lot of these businesses that are somewhere, let's call it between 30 and 50 billion of AUM. And they're trying to figure out what's their growth strategy. And I think in partnership with an insurance company that's growing, scaling, and is reinvesting its capital into that growth, there's a lot of opportunity because the insurance company, as it grows, the asset manager grows, right? So you get the benefit of the scale of the insurance company generating more spread-related earnings, and then you get the benefit of the asset management growing and generating more fee-related earnings. So it's this great combination where through kind of $1 of equity capital, you get two benefits.
So this will anchor, I think, a lot of our discussions throughout the day here. It's a really interesting environment for credit. Interest rates, even if you believe that you'll get one rate cut this year, they're higher than they've been in the last decade. What kinds of opportunities is it creating for you in the credit market more broadly?
So I think there's a couple places that are very interesting right now. I think real estate credit is a good place to be because I think you see regional banks are pulling back, and I think the value of real estate has it stalled out a little bit. So you're going to have to be in a position where you need to refinance these loans, and with SOFR where it is, you're making kind of 9, 10, 11, 12%, on an unlevered basis. So I think those are really good rates of return. We see opportunistic examples. Like, for example, we bought $1 billion of loans out of PacWest Bank. When the regional bank tremor occurred, the banks were trying to figure out how do we fortify ourselves, and therefore they're selling assets. And generally the way that works is they sell their best stuff first. So we were able to buy $1 billion of loans out of PacWest, and already roughly 20% of those loans have already refied themselves out. So it was a good opportunity to be well placed and to be able to move quickly. I think another place that we're excited about is this world where there's a bunch of these kind of growing disruptive tech firms that maybe raised money in 2021 or 2022, and they're going to need some growth capital. There's clearly value in the firms based on the fact that other businesses would love to buy them, because I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses. So real estate credit, kind of structured credit, and growing disruptive tech firms, and then opportunistic credit. Because there's definitely going to be some things that go wrong. So to be in a position to be able to move quickly. We're working on one right now where we're buying senior secured debt at 50 cents on the dollar and taking control of a position.
What goes wrong? If you think about the next 6 to 12 months, there's a lot of concern that these prolonged interest rates will start to create serious cracks in the market. Where are you starting to see them?
Well, there are definitely places where, there's been, I think, if you look at the liability management exercises that are going on, there's been something like 30 or 35 of them. And 14 or so have been kind of what we'll call repeat offenders, where the borrowers have already done a liability management exercise. So they didn't end up kind of solving their problem. They just kind of kicked the can down the road. So I think it's specific to industry, right? If you go back and you look at defaults ripple through industry, right? So generally there's something going on in an industry. So defaults generally spike, in an industry. I think everyone obviously talks about the real estate stuff. I've never found that anyone has been able to predict the thing that's been the problem, right? Generally the thing that is the problem is a surprise. So, I think we're going to see this sort itself out would be what I would bet. But obviously, I think we're also living in a world where, a 4.25, 10-year people think is high. If you go back and look at time, a 10-year at 4.25 is not high, right? So I think we'll see over time the front end of the curve come down, and the back end of the curve will kind of stay where it is. But I just don't see that the higher for longer is necessarily going to be the thing that crushes us.
So moving from credit to equity for a moment here, because you do at Eldridge Industries have a very interesting portfolio that is very diverse across the industries you play in. And if you think about kind of the topic du jour, artificial intelligence, very, very curious on how artificial intelligence is impacting your portfolio companies. Where are you seeing the most promise?
Yeah, so the first thing I would say is that when management and ownership are significantly overlapped, right, the ability to be on the front foot is very different than when management and ownership are completely disconnected. So just take the media industry, for example. A24 is a company that we founded in 2012. 2 years ago, they were the first studio to ever clean sweep all big six of the Academy Awards. Best Picture, Best Actor, Best Director, Best Actress, Best Supporting Actor, Best Supporting Actress. So they clean sweep all six. They're significantly owned by their founders. So they're in a position to figure out how are we going to use AI in order to make our content faster, better, quicker, cheaper. And at the same time, they have the credibility to bring the actors and actresses with them on the journey. So, because let's face it, it's coming, right? So, you have to be able to figure out how do we win collectively, in this journey. You look at what's going on in, kind of large publicly traded media companies, and I think they're on the back foot playing defense because management and ownership really don't wear the same hat, right? They have a very disconnected view of the world.
Is what you're saying that this makes a difference in terms of how they invest in technology, in AI?
I think it makes a difference on whether they're on the front foot or the back foot and how they, kind of come to grips with, we have to embrace this, and figure out how to tackle it and figure out how to do it so we're all going to be on the same page going forward. But the reality is it's coming, right? So I think if you look at, insurance and how we're thinking about how it's going to affect insurance, processing of insurance, call centers, right? We're now using AI in all of our call centers to service our insurance policies, and it's just a better experience, right? We used to have to monitor, calls to figure out how the call center operators were doing. How many calls can you actually monitor, right? 50 basis points of all the calls. Now we basically get full transcripts of every call. When you hear tension rising, when you hear certain words, it automatically kicks that transcript to a manager who can then decide. And of course, what also was happening is every call center employee would have to give a summary of the call. So they'd have to take the call, write down the call, the description of the call, and as you can imagine, no call ever went wrong.
So I want to switch gears here and promised you sports. We'll get to sports because you were really a pioneer here. You're seeing more and more private equity executives, either on their own or through their funds, enter the sports world. From everything you've learned, let's talk about some of the teams that you have. What's the future of the Dodgers after owning it for this long?
I think we're scratching the surface on what the Dodgers can be. I think if I had to bet, the Dodgers will be the first team to hit $1 billion of revenue. I mean, I think we've got a global franchise. We've got some superstars that have amazing appeal. We've got a team that is competitive year in and year out. Right? Every year we look at it and we roughly believe that we have somewhere between 18 and 22% chance to win the World Series. Right? So everything we can do, we're trying to figure out how do we improve the odds of winning the World Series. And I think unfortunately, if it weren't for injuries, you would be able to have a much more easy way to predict that. Injuries are just part of the game now, right? And you have to be able to handle how you think about depth, how you think about the quality of the players, and what they can do. Obviously, one of the things that Andrew Friedman, who runs the Dodgers for us on the sports side, he really focuses on how do we find players that have the ability to play multiple different roles, right? We want utility guys who can play infield and outfield. We want guys who, can hit lefties and can hit righties. And, you're trying to figure out how do you build a portfolio of 25 players. And of course, one of the things that we love about Ohtani, is he gives us a 26th player, right? When he's pitching and he's hitting, we actually have a 26-man roster. So, which is such a unique thing, right? I mean, no one's been able to do that since Babe Ruth. I think our global appeal with our global superstars is really going to be driving the demand. I mean, we were in Korea this year. We opened up this year in Korea. And the amount of people who were hanging around trying to just see Ohtani, it's unlike anything I've ever seen.
What about Chelsea? Speaking of going global, when you got into the Chelsea Football Club, obviously that was a very big moment for an American private equity titan to be getting into European sports leagues, certainly European football, yet now Chelsea is being watched across America as well. What's the strategy? There's very few brands that have the reach that Chelsea has. And Chelsea is you can see it and you feel it differently because it means so much to so many people. And, as I tell everyone, the good news is the bad news. It means so much to so many people. So when things are going well, everything is great. And when things aren't going as well, things aren't as great. But obviously our commitment is to win, right? We're here to win. And, I think, our perspective is, how do we build something that has real staying power like we've done with the Dodgers? And putting together, that team that, is very fluid and comes together, I think that's the first step. And, I think putting together any team, whenever I put together any team, right, it just takes time. That's the only way to phrase it. And, I think we feel very good about the pieces that we have together, the camaraderie that the players have, and what the future looks like. Where is your next big bet in sports?
So I think there's a lot of things going on globally, right? And what's the world has done as distribution costs have gone to zero. I mean, if you go back and you talk to Fox or Rupert Murdoch, and you think about what he did to build Fox, right? At that time, before you could buy the content, right? Before you could buy the intellectual property to broadcast on Fox, the infrastructure that he had to pay for was so massive, right? So just putting together the nodes that would allow for the broadcasting was hundreds and hundreds of millions of dollars. As technology has evolved, those costs have come down, which is why the IP costs have gone up, right? Because, of course, as the hardware costs go down, the soft costs continue to go up because the soft costs you can't replace. The intellectual property is irreplaceable. Obviously, the technology costs going down, there's lots of ways to drive technology costs down and distribution costs down, but there's only one place to go for the intellectual property. So I think that we're going to start to see ongoing global expansion of these brands. I mean, basketball in Europe, what's going to happen to basketball in Europe? Europe has been an amazing place. If you look at the draft this year and you look at where players are likely to be coming from, there's more international players expected to go in the top 20 than there are US players. So, I think these games are growing in demand. So how do you figure out how you position yourself to be, in these markets where there's demand, there's opportunity, and you want to be positioned to capitalize on it.
CVC, others, Redbird, they've considered putting billions of dollars into college sports. Would you consider putting similar dollars in?
I think college sports is on the precipice of major change. I think if you look at what college sports should be thinking about, right, there's a couple things right now that they're struggling with. One, NIL is the wild, wild west, right? So there's no standard, right? But in order to standardize NIL, there's going to have to be collective bargaining. So how do you figure out how to do collective bargaining in a system where it's very fragmented? Secondly, you have this transfer portal where, that again is the wild, wild west. So there's going to have to be some form of regulation, especially now that there's compensation, because this is going to change everything. I think we're in the early days and people really don't understand. But, I think one of the things that I'm part of a group and we're thinking a lot about, right, is how do you build a proper, league with maybe 10, maybe 12 divisions, maybe 6, maybe 8 teams per division, right? There's roughly 130 Division I schools. So how do you give them all the opportunity to compete, right? But of course, there's major brands that are going to want to make sure that if they're chipping in, that they get what they deserve because they're the brands that everyone's watching. So, in a perfect world, you have 82 teams, 70 teams, 85 teams, something like that. You have a relegation and promotion element to it where the other teams can come up and compete. And you really start to think about how do you make it so it's truly national, right? And so I think there's a commitment, but there's obviously a lot of ingrained challenges in that because there's stakeholders that aren't interested in losing what they have today. So, but ultimately, I don't see how you're going to deal with NIL and you're going to deal with transfer portal and you're going to deal with collective bargaining without a proposition that's much more complete.